let's get started, shall we? Because we've lost a few minutes here, but not a lot. It's only 7:05 here in Melbourne. As you can see, I'm inside because I'm in Melbourne in lockdown. But let me introduce the team for you today, who we also have joining us for this webinar. This webinar will be about your super, the impact of your super, what's happening with current recent events such as Corona, the federal budget, what's happening in the US, and how is this impacting your super? And what can you do with regards to your super to help protect yourself against some of the volatility in the market? I know some of you are obviously interested in learning a little bit more about how you can invest in property using a self-managed super fund. So we're going to talk about that today. So joining me today, we have our special guests, and I'll just bring them up. Okay, Nicola, if you want to turn your camera on, and also Thomas as well.
Hi, everyone.
Hi, guys.
Excellent, Jace.
There at the end. I lost the whole window. I lost all controls. I had no buttons to press. I just had a black screen to work with.
Well, anyway, as you said, at least we know it's live and you're legitimate. You know, this pre-recorded stuff that gets rolled out week in, week out. The content's real.
Absolutely, absolutely. So look, Thomas is from Sapient Financial. So Thomas is our self-managed super fund specialist. He's also a financial planner, a wealth fund manager, and you know he's been doing this for 12 years. So plenty of experience. Thomas is based up there in Sydney. We're obviously recording from you in Melbourne. I'm at home at the moment. Obviously, Nicola is as well. Nicola helps with our education and our marketing. She'll also be assisting us today. Throughout this webinar, there's going to be a lot of interaction. Obviously, we're answering a lot of questions. We can see that we've got approximately 100 people there. So we've got a lot of stuff to cram into this webinar. We've got heaps of giveaways as well. We've got a lot of ebooks, reports to give you guys, and we've got some special offers throughout the course of this webinar, and also some special offers at the end. So make sure you hang in there. So apologies for the false start, but that's the wonderful thing with IT that we experience from time to time. So let's get started. So what we're going to do first is we're just going to quickly just sort of touch on sort of where we're at the moment, you know, where we started at the start of the year, particularly when COVID hit us, sort of how that impacted our super. What does that mean moving forward for our super? But we're also going to speak to Thomas, you know, about, you know, what's happening over in the US. You know, there's a lot of media coming from the US at the moment in terms of the election, and what does that mean, and how does that affect particularly our markets here and your super funds, and of course, you know, what does the federal budget mean for you and your super? There's some great reforms that are coming in there as well. Then we'll finish up with Thomas. Then I'll go into a little bit more detail in terms of how to build a portfolio. I'll use a case study, one of our clients who's incorporating buying properties in their personal name and also properties in their super fund, how that works, how to maximize those opportunities as well. So guys, thanks a lot. I'll say goodbye to you for the moment, and I'll keep pressing forward with a few slides, and then we'll come back to you and talk a little bit more about those topics. How's that sound? Good? Fantastic. Okay. All right, so let's get stuck into it, shall we? So again, I'll just share my screen and hope we don't have any issues. All right, so here's the presentation. Okay, so as we said before, if you are having any issues or your computer is freezing, you can just reboot the room or stay on the page. We will, throughout the webinar, we'll be asking some questions, so send in your questions. Nicola will raise some of those, and also we'll stop at various points throughout the webinar to answer more questions. We obviously won't be able to get through everyone's questions tonight, but we will come back to you at a later date. The coaches and consultants can help you with that. There's also some free resources on the panel that you're looking at to the side. We'll have some polls come up. We'll have some free resources. There's some resources there, so click through that. There's some files and videos for you guys to have a look. So why listen to myself? Well, you wouldn't listen to me if I was an IT guy, that's for starters. But if you want to learn a little bit about property, you might want to get professional advice. So look, I'm a qualified financial advisor, fully licensed estate agent, qualified finance broker, a licensed builder, investor, developer myself, and I'm the managing director of Alliance Corp. So what do Alliance Corp do? Well, we're national buyers advocates. So basically we help people build property portfolios, very similar to what they call property brokers in the US, very similar to a real estate agent, except the real estate agent helps the seller. What we do is we help the buyers, in particular investors that want to build big portfolios from across the country. We source all different types of strategies. We have a diverse range of strategies. We buy new, established, off the plan, all different types of properties. Mainly residential is what we focus on. We've been around now since 2008. We have well over 1,000 clients, and I've purchased over $1 billion worth of property for my clients. So I know a little bit about property, but what we're really going to talk to you tonight about is more about your super, but also how you can set up a self-managed super fund. So before we speak to Thomas about those topics, let's just have a think about where we're at today and what we sort of experienced, particularly over the last 6 months, because obviously one of the biggest impacts that we had in our market was COVID. Obviously, it's been devastating to the economy. It's devastating to a number of industries out there. And even at the start of the year, no one really knew what to expect. But if you do have a think about the strength of the market before COVID hit us, if you have a look at the fundamentals, you know, we had a shortage of supply. We have ever increasing demand. Vacancy rates were incredibly low. You know, the interest rates obviously incredibly low, and all of this led to you know, some solid predictions for the year. You can see here from SQM Research at the time, these were their forecasts for the year, and you can see pretty much in every state there we're looking at some positive growth. So fundamentally, the property market was very strong, and I think it's because of those strong fundamentals which has managed to get us through Corona, because you know, without those strong foundations at the start of the year, it may have been a little bit different in terms of where the market is today. Having said that, though, of course, when Corona hit us, it was all doom and gloom. Of course, the media jumped onto this, and you'd open up the newspapers and you're reading all these sorts of articles about how the property market's going to drop again by another 30%, and you know, and everyone's panicking with regards to, you know, any properties that they may have purchased or own, or again, a lot of people are really sort of struggling as to whether they get into the property market. And why would you if you're seeing the newspapers and the media come out with headlines like that? But look, as we know, guys, it's all about clickbait. You know, it's either a booming market or it's a market in decline or a crashing market. You never really hear, oh, look, the market's just sort of prodding along and doing its thing, right? And it's evident, as you can see there from the graph that I've put up there for you. This goes back to 2010 because we monitor this a lot because we're in the industry. Obviously, any media reports impact our business. It impacts, obviously, the client's view on what they should be doing next. And you can see here, it doesn't matter whether it's 60 Minutes or, you know, economists out there. At various points, they've predicted a lot of property market crashes and corrections, a lot of them anywhere between 30 and 40%. And as you can see, over time, that hasn't eventuated. Look, in the last correction that we had towards the end of 2019, our markets pulled back approximately 9%, not a big deal, but then it quickly came back towards the end of 2019 and early this year. So it's very important that you don't pay too much attention to obviously what you read in the papers, because again, you only have to open up the papers now. And what are they saying now? Now they've just flipped again. All right. So all of a sudden, a lot of the banks or a lot of the commentators that were talking about these crashes are now actually talking about quite a significant recovery in the market. So very quickly, we're going to see that turn around. And if you have a think about what has actually transpired since COVID, again, this is SQM just showing us that, as you can see there, in terms of annual growth, we haven't gone backwards. We're still in the positive. So anyone that was looking at their property values 12 months ago and we're looking at them today, as you can see, they're consistently outside of Perth, we're still in the positive. Like if you have a look at the last quarter, you can see here that Sydney took a bit of a hit, Melbourne took a bit of a hit. But overall, our markets are still in the positive. And now the tune has changed out there in terms of what is this moving forward. Everyone agrees that while we need to get through this, we will get through this. There's plenty of stimulus out there. And as soon as we get through this, the markets will rebound quite quickly. So look, this has created some great opportunities for our investors. It's quite funny that, again, this is referring to the median price. It's not consistent in all property markets because there's markets within markets, and certainly where a lot of our clients have been buying, a lot of the clients buying some of those growth corridors, they've actually gone up in value because you've got all the first home buyers going out there because of all the grants that they have, including the home builders grant of $25,000. They've actually pushed prices up. So had you purchased out in some of those growth corridors, like you may have got a townhouse or a house and land package, your property's actually gone up, your land's gone up. Okay, it's only in the sort of the middle ring around a lot of the major capital cities where we've seen a little bit of a decline. So again, there's plenty of opportunity out there, and just be careful what you read in the papers. Overall, I think nationally we've lost about sort of 2 to 3%. It's not a big deal at all, and it depends on where you buy. So I wanted to start with that, but now what I want to have a talk about is what does that mean for us moving forward? In particular, what does it mean for you that have some super there? Because I remember that when COVID did hit us, due to the volatility of the market, obviously your super balance would have taken a significant hit. We had a lot of people calling into the office. They were concerned about that. We had a lot of clients that were about to set up self-managed super funds, etc. So let's have a chat about how COVID has impacted that. What does that mean moving forward? Also the federal budget and the US election. So I'll get Thomas back in, mate, if you're still there. We're not going to, I hope you come back. I had a few technical, there he's back. Oh, thank God for that. All right. So Thomas, let's have a little bit more of a chat. All right. And I'll just get rid of this screen. There we go. Okay, cool. All right, so just quickly, Thomas, talk to me a little bit about sort of what's happening out there in the marketplace, particularly with people's super and the impact of COVID, right? Because I know that, look, we were in unprecedented times. A lot of people were concerned. A lot of people were looking at their super balances and calling me up and going, Jace, my super balance is getting smashed. Can I expect the same sort of outcome with my property? So how much has COVID sort of impacted super funds since the start of the year?
Yeah, great question, Jason. Certainly something that we're getting asked a lot of as well right now by our clients. I guess we've pretty much seen an unprecedented time of volatility in the early part of this year, and certainly something that not only gripped financial markets in the US, but certainly spread globally very quickly. I guess in like a digital age with information traveling as quick as it does, no markets are sort of insulated anymore, and we're just sort of seeing that basically all markets all across the globe, no matter where investors were invested, were sort of like, I guess, at risk, and I guess nowhere was safe. And I guess government sort of stepped in and did help markets quite a lot. But in saying that, we're still sort of down, below our previous highs here in Australia in a lot of ways, and many investors are still underwater and are wondering what, I guess, not only what's a bit confused by what's happened to date, but also like where to from here. There's a lot of moving parts. There's government stimulus at play that may be getting pulled out. So the COVID thing has certainly concerned a lot of investors, and I guess particularly investors that are getting, later stage, towards their retirement, as well as those that are maybe in their 40s and 50s that are wondering how they play this, maybe take advantage of this opportunity because they know they've got time on their side if they do make some wise decisions now. So certainly a lot of interest. Okay.
Clients when they were calling in, they were quite panicked. I know that currently with the super funds sort of dropped back roughly 12%, but I know they've made some gains. The market has shown some strong recovery, but there is quite a lot of volatility there, particularly with Australian super funds that can invest as much as up to 80%. In shares that obviously are impacted in times like this. What about your thoughts? Like I had a lot of clients call us up too, particularly younger clients too. And although we don't give financial planning advice, we leave that up to you guys. I even noticed my staff, a lot of them were asking about withdrawing some of their super early. What were your thoughts around that?
Look, I guess if someone's in a position where it's the only opportunity. Well, it's the only option they have. It's the only option that they have, and if they've lost their job, then it's hard to tell someone that that's not a good idea for them at the time. Though I guess in saying that, anyone that didn't really need the money, it's probably not wise to be pulling money out of what is like a safe haven and a great place to invest because of the low tax rates and that sort of thing, just because they feel like going and, having more money to spend. So we did sort of, I guess, broadly, speaking, just warn clients against, going and taking money just for the sake of taking it, because effectively what you are doing is borrowing from your tomorrows, But yeah, that certainly did happen a lot across the market. But maybe I feel that in some cases, not all investors maybe needed to do that and saw it as an opportunity to.
Yeah. Well, look, I was the same. I discouraged it because it was particularly a lot of the young staff members that were doing it. And, I worked out that, if you take out $20,000 in your 20s, it's going to cost you $60,000 later down the track. So we weren't a big fan of it. But look, how long do you see that this might continue to sort of impact people's super funds out there with what's going on with COVID? I know you don't have a crystal ball.
No. Look, it's a really good question. I mean, it still is largely unknown. It's kind of dependent on a couple of different factors. One naturally being when it is that we find a cure, or a vaccine. And it's not only when science maybe discovers a vaccine, but it's also like how can you produce that vaccine en masse to then distribute it, to then have everybody, treated, and then everyone back to sort of like life as they were before. Now that is a little bit of a crystal ball. It's difficult to say, how and when that will roll out. There's also a few other things as well at play here, and one of them is around what happens with things like the JobKeeper as well and how markets sort of recover, because at the moment, a lot of our economy is largely, or enterprise are being propped up by the JobKeeper, which was pretty lucrative. I think none of us would have ever thought we'd ever see a situation where the government would be supporting businesses to the tune of $1,500 per fortnight per employee that was suffered from a pullback like this. So there's also a few things at play from a government stimulus point of view that are worth considering, and when that gets scaled back and the impact that has, because the JobKeeper at $1,500 a week, that worked out to be roughly about $40,000 a year prorated, right? Now, if you had an employee that you were paying $40,000, $50,000, $60,000, $80,000, even $90,000, you'd be reluctant to maybe let that employee go because you were getting paid $40,000 from the government. So it's going to be interesting to see when that gets scaled back, at what point maybe businesses that have got employees they don't need maybe start letting them go, and then what effect that has on the broader economy as well. So yeah, you're right. It is unknown. A couple of points worth noting is that it took until 2013 for our market here to recover from the GFC. So that's just like a little point worth noting, that we've got a bit of a sugar high here in markets with the government stimulus off the bottom, and now I think it's going to be more of a slow grind from here. Throw in that the US election and what happens in in world's biggest capital market in America, and there is a bit of uncertainty and volatility to come, I think, for sure.
Yeah, so let's talk a little bit about that, because I know that there's been some news reports coming through, and obviously, love him or hate him, the Donald Trump loves a fight, and he's made it pretty clear that he's not happy with some of the ballots and everything that are taking place over there at the moment, the voting system. He has mentioned that he's probably going to contest it if we've got contested results there. How does that sort of impact our markets over here, and in particular people's super funds?
Yeah. So I guess a couple of things there to note just on that election is that historically contested election are never good things for markets at all. We previously saw this back under Gore and Bush. Those elections were contested. We had the results that were unknown for a period of time. We saw markets in that case fall about 11%. And I guess given that Donald has said that there potentially might not be a peaceful transition of power if he loses, I'm not sure where this election is going to go, but we probably should brace ourselves for potentially just a genuine unknown result, given how close it is in some of those, contested states right now. Even though we're seeing Biden up in the polls, we saw this before, that Hillary was up in the polls and then lost. So I wouldn't really say that, the polls are a great indicator right now, and certainly contested elections are never great for markets in general. Yeah,
So what do professional investors do then, to protect themselves against that risk? What are they currently?
Cool. So, I was reading some articles the other day. I know AMP's head of capital markets, Shane Oliver, said that he potentially sees, a huge financial storm sort of brewing. We're seeing huge outstanding interest in derivative products right now by investors expecting and forecasting increased volatility, and by trying to, I guess, anticipating that investors are out there maybe buying a lot of derivative products, buying insurance to protect their portfolios on the downside. And the outstanding interest in options is a pretty good way to gauge, how.
So for those viewers that aren't familiar with the derivative, can you just explain that quickly?
Okay, basically derivatives are like put options, call options. What they are instruments where we can basically hedge risk. Yeah, it gives us the right to sell a share or an index at a certain time in the future, or potentially buy a share or an index at a certain price at a certain time in the future. Yeah, often investors that have got positions or fund managers will take out derivatives as insurance against potentially volatile times ahead, and we're seeing a lot of that right now, which I guess is an indication that that's what markets are factoring in.
Okay, cool.
Yeah.
So then, what can we expect? So obviously, we can expect some sort of impact on people's super balances in around that period. Would you expect, or?
Yeah, I mean, I certainly would expect that. Yeah, as given that most people's superannuation in Australia has got a very material exposure to the share market, I would expect to see that superannuation balances in general to be quite volatile over this coming period, right? A couple of interesting facts around this is that 39% of Australia's share market, the funds invested in the Aussie share market, comes from industry and retail super funds, right? So broadly speaking, I mean, if you said that that's 40% of the Aussie market comes from funds, then by virtue of that fact, you'd expect all Aussie super funds to have a fair exposure to the market. Yeah, especially investors that are invested in maybe growth or higher growth strategies, they could have anywhere up to 80% of their portfolio invested in the share market. So, I'd say for investors to basically expect a little bit of volatility maybe on the horizon in the next sort of month or two for sure.
Okay. Now, aside from having to deal with the volatility there, on a brighter note, with the federal budget that came out recently, talk to us about some of the reform that has come out of that budget.
Yes.
People need to be aware of with regards to their super.
Yeah, the government's, I guess, has seen that there's potentially been some flaws in the system or in the system. Basically, there's ways they could make the system better, I guess, as a glass half full guy. Some of them are around basically benchmarking the super funds that are out there, the large industry and retail super funds. And by doing that, what they're trying to establish is, I guess, better performing funds from those funds that are performing as well for members, being transparent about that so investors have got that choice and visibility. And in some cases, poor performing funds basically not allowing them to take any new members for a period of a couple of years on the back of any poor performance that is recorded. Now, that's a very good thing for investors to have that transparency. I guess the only downside I'd warn against that for the investor is investors need to be mindful that if they're in some of those funds, and those funds then have potential unknown, operating issues because they don't have more funds coming in. Funds management tends to be a business of scale. Now, if you prohibit a business's ability to continue to grow or to achieve that scale, then maybe investors that are in some of those funds might sort of suffer in some way from being locked into those poor performing funds, or those poor performing funds not being allowed to take new investors on board.
Right. Because I know that with one of those reforms, as you said, I'm still surprised, apparently there's still, 6 million multiple accounts out there. And I know that it's been in the media for a long time about some work being done there to correct that. And, there's a number of different websites, but I'm still surprised that there's still so many people out there that have multiple super accounts.
Definitely. I mean, Josh Frydenberg came out and said that they estimate there's $450 million a year in unnecessary fees being paid by investors that have got multiple accounts, right? So, I mean, I guess as a general rule, I would encourage all investors to try and find some way to engage better with their money, to maybe seek professional advice, or to at least maybe even go onto the government website and work out ways to consolidate their super into one balance, or to maybe even find an asset class that they are more engaged with. And I know that the work that you do, with all your staff at Alliance Corp, really helps investors engage with their money, especially when it comes to property, and they do feel that stronger engagement there. That's a potential option, or also just consolidating their funds and finding advisors or fund managers that they can trust and follow closely. Yeah, absolutely. So some good policy there. So when it comes to discussing the setting up of the self-managed super funds, right? So
what are the main sort of reasons? Now, obviously, we've talked a lot about some of the volatility that you can experience with your self-managed super fund for the reasons discussed. What are some of the other reasons as to why people come to you and are considering setting up a self-managed super fund?
Yeah, I mean, broadly speaking, a lot of investors like the idea of having a bit more control. Now, it's not necessarily for everyone. Some investors, I guess, maybe come with an element of like sophistication to investing because they've worked in finance or have got a background in finance or have been educated, around that. That's kind of like a big driver. In some cases as well, I think some investors are a bit disenfranchised or maybe disengaged with some of their funds, though in saying that a lot of the big industry and retail funds are doing a good job of trying to engage better. The key driver, I would say, for anyone setting up a super fund is often maybe to get an element of leverage if they want to buy property. That's always popular. To invest in an unlisted asset of sorts or an asset that they can't get exposure to that they would like to have exposure to, i.e. might be like a fund manager that might not be listed within their current suite. Property does tend to be the key driver in Australia and the ability to leverage that money as well. Not necessarily, at a crazy level, but just have an element of leverage in their portfolio, especially if they've got a long time.
I know that recently one of the biggest reasons is the volatility that clients have been raising.
Yeah.
If I just bring up, just to give our viewers a look at this graph here. So as you can see on this graph here, this is showing the Australian stock market performance going right back to 2005. That's the blue line there on the screen. And you can see there the average median price for property. So you can understand why sometimes people find it a little bit frustrating when either investing in shares themselves or even watching their super balance over time, go through this volatility. Do you find that is one of the major reasons also for your clients?
Absolutely. And I mean, I guess we really saw that a lot earlier this year when you have a look at what happened to markets in the month of March. That really sort of shook a lot of investors quite deeply, especially, investors that have got more material amounts of money. I guess maybe the millennials of the world sort of view super as being something that's not a very big part of their portfolio. But once investors sort of get into their, maybe late 30s, 40s, 50s, 60s, etc., that becomes a material part of their wealth. And to see that volatility simply eroded is certainly is a cause of great concern for many investors. Absolutely. And property, I guess what we know is that it does tend to be an asset class with lower volatility, which, suits many investors. Yeah.
Okay. So what I wanted to bring up here was also another slide, which is a very simple illustration in terms of one of my favorite reasons as to why you would consider property in general, and that's leverage. We talk about that a lot with clients. We talk about how residential property can be a fantastic investment when you take into consideration the leveraging capabilities. When you think that you can buy such a large asset for such a small deposit, being as little as 10%, and really leverage your funds over time. Now, you can also do this obviously through your self-managed super fund. Here's a very simple example of someone that doesn't have a lot in their super. In this example, sort of the minimum that we can sort of play with is around that 130 to 140. Leaving that in their super fund, as you know, over the last sort of 10 years now, the average super fund with a balanced portfolio has been somewhere around that sort of 6 to 7%. But it's not leveraged. All right, and this is the problem. It's no different than a client coming to me saying, Jason, I've got $500,000 of cash. I want to go buy a $500,000 investment property with that. It makes absolutely no sense. So we often talk to clients about one of the biggest major reasons is being the leverage, because we're able to take that $130,000 at a 70% lend, borrow 70% from the banks, turn it into a $400,000 purchase. Now, unfortunately, your photo is just cutting off that slide a little bit, but if you can see there, on an average return on a property, say that's giving us 10%, which is a mixture of capital growth and our rental yields, our rental income, even with covering some of the finance on the loan that we would take, that 70% loan, call it say 4 to 4.5%, we're still looking at an average return of say 6%. But the difference is, thanks Thomas, the big difference is that is a 6% return on a $400,000 investment, all right, as opposed to 6% on super. So you can see there the difference. So by far one of the major reasons when talking to our clients about why you would set up a self-managed super fund, aside from taking back some of that control or maybe diversifying and leave some funds in there, but maybe use some of those funds to invest in super. So often the people don't realise too that you can do it on such a small amount. So sometimes, Thomas, and you can probably come back now. Sometimes, Thomas, we have clients come to us and they say, "Oh, Jace, my financial planner told me that I had to have $250,000 to set up a self-managed super fund and buy a property." That's just not accurate.
Yeah, look, I mean, it's the minimum balance inside super is a real moving target to set up a self-managed super fund. I guess there's a lot of different circumstances that need to be taken into account. But I mean, yeah, your illustration there, I guess, is great in the sense that it just shows investors the power of being able to leverage their money, especially for people that maybe have got, husband and wife that are both working, that are both making contributions, that might be making a salary sacrifice. So, yeah, I mean, every situation is different. I guess that's just got to be analysed on its merits. But yeah, absolutely, mate. You make great points.
And look, it's also worth noting too, and some people don't realise this, that in order to get finance to buy these properties, the banks still need to assess the individual circumstances of the investor. Although obviously this property is purchased through a separate entity, the banks still need to take into consideration the income because they do have contributions obviously going into the fund to help service that loan. But in general, we generally find that an income of somewhere between around that 120,000, either individually or a joint income, is enough to service that loan. Or if your income is a little bit less than that, well, you just need to tip in more funds or more of your super, and then obviously reduce that loan component or that LVR. But again, it's very achievable for a lot of people, particularly because if you think about the average super balance, even for males, it's just over 200,000, and women, it's just over 100. It's not a lot of super. A lot of people don't have a lot of super. So to think that you can still get in with as little as a sort of 130, 140 is still, I imagine, of interest to a lot of people. And we've got clients that are doing multiple purchases in their super fund at the moment. If we just have a chat about some of these other benefits, if you want to run us through some of those other benefits, some of the tax benefits and things like that.
Cool. So superannuation and tax. So I guess superannuation tends to be much lower tax than what investors are paying in their personal name. Yeah. So by virtue of that, the fact whatever they invest in their super fund, they're able to save money faster in their super fund because they're paying less money on what would be maybe the deposit on a property or an investment. On the flip side, when they then go to sell those assets, capital gains tax in superannuation is a rate of 10% and income tax is a rate of 15%. Now, both those tax rates are probably much, much lower than most investors or many investors are paying in their personal name. So the post-tax outcome of investing, selling an asset at 5, 10, 20 years from now can potentially be much, much more lucrative by holding that inside a super fund. And is the choice of, I guess, so many Australians now. There's now like 1.3 million members of self-managed super funds in Australia. So they are a very popular choice by many investors. I guess it just depends on every individual circumstance. But yeah, we're certainly seeing a lot of activity, across Australia, and numbers coming out of the tax office that suggest there's still quite a few being set up across Australia.
Absolutely. So I guess for a lot of our clients, a lot of clients are doing both. They're obviously buying properties in their personal name and really taking advantage of also some of those tax deductions there, but they're leveraging the ability to put in very small deposits, but also too they're purchasing properties through their self-managed super fund. Now, in terms of an exit strategy, that's where obviously they'll be speaking to the financial planners and look at a combination of balancing that debt, whether they decide to sell off some of the properties in their personal name and pay a little bit of capital gains, but then pay off the properties that they've got in their super funds to get those tax advantages, or potentially do it the other way around. But certainly a diversified portfolio of having both those strategies in combination is certainly going to make a massive difference with regards to their retirement strategies. Talk to us a little bit just about the structure. All right, now this is obviously very high level, guys. For those of you who want more detail, we've got some ebooks and everything that we're going to give to you. Just at a very high level for those people that don't, aren't familiar with how a self-managed super fund works.
Yeah. So let's just say, broadly speaking, a lot of people ask me about is what does the cash flow in a super fund look like, right? At its core, what we have is like a super fund's got a bank account that tends to be just like a normal BSB and account number. Okay. what's going into that bank account, if someone had, say, a property, then what they would have going in would be rent. They would have 9.5% contributions, or potentially more, depending on their award they're under, coming in from one or more members. So let's just say we've got a typical situation, husband and wife both working, then 9.5% of each of their super, each of their salaries, being the normal super contributions, is going into the account. And what will be going out is the principal and the interest payments. Yeah. In addition to that, if the super fund had any other investments as well, which would always encourage, levels of diversification, then any dividends or, coupons from other investments, that would also be going into the fund. Okay. And I guess in an ideal world, investors are setting up their super fund so that the rent plus their 9.5 contributions, well exceeds what the principal and interest repayments would be. And therefore now they've got they've built a super fund that's cash flow positive, that's able to pay off debt over time, and potentially, maybe pay off all of the debt by the time they retire, and they've got a debt-free asset inside their super fund. Yeah.
Absolutely. So we find that when we run our cash flow reports on the properties, they tend to be a little bit more neutrally geared. The interest rates are a little bit higher when you're investing through your self-managed super fund, and you are making principal repayments, so the payments are a little bit higher. But when you actually look at the cash flows, even without the contributions that the client's putting into the super fund, the property itself is still neutrally geared, and that's mainly due to the fact that they're putting in the deposit from the self-managed super fund at 30% has reduced that loan significantly enough that a lot of those properties are neutrally geared. What we might do now is we've got some questions coming through. Nicola will also throw in any that are coming through the viewers, and I've got a few list of questions coming up now.
Before we jump into the questions, I'm not sure if you've told everybody that we've got a special offer to look forward to at the end of the webinar.
Yeah, absolutely. So we'll be going through some stuff at the end of the webinar. We would just want to give you guys as much value as we can. We've got some ebooks and things like that throughout the course of the webinar, but at the end, I'll run through something for those viewers to really give you guys something that's specialized, so you can really delve a little bit deeper into how this strategy can really work with you. And Thomas is obviously going to be a part of that as well.
And
so.
Sorry, Jason, throughout the webinar, if anybody would like to request a free strategy session, they can click on the link that is on the right-hand side to access that. Yep.
So I've got some questions running in here. I've got Susan here's quick question there. How long does it take to set up a self-managed super fund, Thomas? What's the process there?
So technically, to set up a self-managed super fund doesn't take that long, as in to register the entity names. What does take a little time is just waiting for the tax file number and the ABN number to be generated by the tax office, pardon me, and then also to roll the money over from investors' existing accounts. Broadly speaking, you would say up to 28 days to get the super fund registered with the ATO, up to another sort of 30 days to have the money rolled over from investors' existing accounts. You're sort of looking at 60 days start to finish, potentially a shorter time frame than that as well, if your super funds, where your fund is now, are rolling over the money a little bit sooner. But just to manage expectations, we say about 60 days until there's cash in the account from start to finish. Okay? Yeah.
Okay, Kieran's asked here, how many people can set up a self-managed super fund? How does that work?
Great, this is a really good question. Self-managed super funds can have up to 4 members. This can be particularly useful in the case of family. So if you've got, mum and dad, 2 children, we can have a fund up to 4 members. I guess most common is that we've got, 2 members in a fund, often, 2 people in a relationship. But we can also have funds between business partners, friends, like-minded investors. But I guess the common one is between, husband and wife sort of scenarios. But yeah, up to 4 members is also popular. It helps build like the family unit, and maybe even helps when it comes to succession planning as well down the line.
Okay, cool.
Yeah.
Maria here has asked, what is the minimum amount we can put into a self-managed super fund?
Oh, good question. So every year we're allowed to put in up to $25,000 per year in what we call concessional contributions. Now that's made up of the 9.5% we are paid from our employer, and also potentially any extra money we wish to salary sacrifice. In addition to that, we can also put in up to $100,000 per year in what's called non-concessional contributions. That's simply money that we transfer from our bank account directly across into the self-managed super funds bank account. So the answer there in total would be $125,000 per year. If investors want to get more in, there's also other ways we can do that, because there's other rules where we can bring forward future contributions as well. So yeah.
Okay, Dale's asked here, is there a way of developing property through your self-managed super fund?
Developing property is a little bit trickier. The answer is, in short, yes, you can develop property inside your super, provided you don't have a loan against it. Some of those more sophisticated strategies are things that we do talk to investors about, and I guess it's on a case-by-case basis. So if any investors had any questions, they could ask us about that, and we can sort of present them with all the facts around what they can and can't do then. Yeah. So the answer is, yeah, you can. Yeah.
All right, Victor, he's asked, is it hard to get finance when buying properties through self-managed super funds?
Yeah, the answer is, like, there's plenty of institutions that are lending to self-managed funds. That there would tend to be something that we would encourage investors to have that piece of the puzzle solved before they sort of came to us to talk about self-managed funds. The reason is, we'd never want to set up a fund for an investor that wasn't able to get finance down the line. So we would sort of say, look, have a chat with a broker beforehand, get that pre-approval of the finance, and then come back to us before we'd actually set up the fund. Right? But I guess any clients that have got any inquiries about that, reach out, have a chat to us, and we can sort of help solve that piece of the puzzle for them before they proceed with the super fund. But the answer is there's plenty of options out there for finance.
Okay, fantastic. All right, well, Thomas, thank you so much for joining us today. I still want to get through a bit because now I want to show people how to bring this together in terms of building a property portfolio with super and how that sort of works with some of the cash flows and incorporating that with a portfolio in their personal name.
Yeah.
What sort of closing comments do you have? Now, obviously, people can ask more questions and we can send them through. Also, at the end of this webinar, I'm going to give people the opportunity to get involved in a special offer, to get some personalised advice, etc. But what other closing comments might you have for people out there today?
Look, I would say that we kind of get these big economic pullbacks, it tends to be once every 10 years. The previous one was in 2009 with the GFC. Before that was like the tech wreck at the end of the 90s. I would say, like, times like this are really opportune times for investors to be at least like reviewing their portfolios and looking to take advantage of the circumstances that we have, and potentially try and set themselves up and make a decision today that your future self will be thankful for that you made. So yeah.
Fantastic, mate. Thank you so much for joining.
Yeah, excellent. No worries. Great to check in. Talk to you guys soon. See you. Bye.
I'll speak to you later.
Bye.
Okay, guys. So we really thank Thomas there for helping us out there. What I want to do now is continue with tonight's presentation by first of all offering you this ebook. So a lot of you obviously want more information. You want more specific, detailed information. We've got an ebook there for you. Nicola, is that right? There should be a pop-up on the side that they can grab that ebook?
Yeah, that's right. That should be appearing on the right-hand side now.
Fantastic. So, guys, we've got more ebooks coming to you as well. So grab that ebook, have a read through that. All right. Now, just a reminder, if your screen freezes, you can refresh that. Feel free to write questions in. When Nicola gets those questions, I'll answer some of those questions as we go, so we can keep this moving quite quickly. So what we're going to talk about now is how to build this portfolio using self-managed super fund properties in combination with your existing portfolio. And for some of you there that are watching this and haven't yet bought an investment property but are thinking about doing it, let's quickly touch on some of the main reasons as to why. The first one being that there's more millionaires created through property than any other asset class. That is where our wealth is in the nation. It's bigger than the share market and our super funds and all the rest of it. Have a think about the people you know. Have a think about where their wealth is. It's usually tied up in their home. It's tied up in a property somewhere. Also, don't underestimate the power of the record low interest rates at the moment. Never have they been this low in the past 50 years. It's incredible, the cash flow positive income. People have literally replaced their income just through their portfolio, particularly recently with those record low interest rates, and I'll touch on that shortly. Also, significant tax deductions, as you know. A lot of our clients will get anywhere between $6,000 to $11,000 back in tax every year per property. One of the clients that I'm going to use in this case study no longer pays tax. Imagine that. And because they've got a PAYG tax variation form completed with the accountant, their full pay packet gets paid into their bank account. Imagine that. Your employer's not taking any tax out. That's all coming into your pocket because you're an investor, you own investment properties. Property is an easy asset to understand. It makes sense. Unlike, I guess, the share market, which is very tricky and very volatile. Look, we all need somewhere to live. We all need shelter. It just makes a lot of sense. It's tangible. We can touch it. We can feel it. And again, that's why people like property. But one of the most important things is leverage, which I'll talk about in a minute. The one I skipped there was the banks. All right, the banks see property as a low risk. So obviously, when you're assessing any sort of investment and you're looking at returns, you've got to measure that up against the risk. And a lot of people come to me and they go, well, just like at COVID, Jace, what does this mean for our property markets? You know, is my super balance going to do the same as my property? Well, my response is always the same. Number one, I don't have a crystal ball, but what I do know is I know that the banks out there are spending millions of dollars on this sort of research. Because at the end of the day, the banks are the ones lending you the money, not me. Yeah. This is the bank's money. You don't actually own that investment property, right? You don't own it until the loan's paid off and you've got that title back. So of course the banks are going to do a lot of research and due diligence. They're lending you the money. They're taking risks themselves. You know, these guys make billion-dollar profits. So of course they're going to spend money. And now I can tell you now, when you borrow money to buy property, the fact that they're going to lend you almost 100% of the value of the property is telling you something. You know, when you invest or you want to take out a loan to invest in shares, normally the banks are comfortable with 50%, or if it's blue chip, maybe 60, 70. Property, it's 90. All right, they're not going to be lending you almost 100% of the value of that asset if they think that that asset is going to nosedive. It just wouldn't make any sense, right? So again, the banks are telling you where to invest. Leverage enables you to purchase multiple properties. All right, so leverage is critical. So I often talk about the scenario where if you had $100,000, what would you do with it? Or if you leverage it up 50% in shares, you had $200,000 portfolio. Let's assume your returns are 10%. Right, but the property guy is going to go, hang on, I can leverage that to $1 million of property. I'd rather get 10% on $1 million rather than 10% on 200, right? So obviously there's other varying factors, but again, there's some of the key reasons as to why you would consider property, and certainly consider property as a long-term strategy. Right, I'm not talking about flipping property or doing all that. Over the short term, I'm talking about having a long-term view with a lot of this stuff. So one of the strategies I want to talk to you about, which is super, super important when you build your portfolio.
I think, were we going to ask everyone how many properties you currently own? Just a quick poll.
Oh, yeah. Sorry, guys. That's why I got Nicola here. Just a quick poll. There's a poll on the right-hand side. Let's have a look at who's online today, and let's get a good bit of a feel. Do you own? What are the questions?
How many properties do you currently own?
How many properties do you currently own? All right. So that's the poll there. It should pop up on the right-hand side, and we'll give you those results shortly. All right, so what is portfolio grade strategy? So this is super important, right? Because a lot of people come to me and they go, Jason, I want to buy this property. And I go, what property? Oh, this flyer, I've got it from realestate.com. Doesn't it look awesome? I go, that's fantastic. Give me all your research. And they go, well, what research? It's around the corner from my house. I really like it. I go, you know, what are the vacancy rates in that area? What are the rental yields? What are your cash flows? What's happening in that location? What are your forecasted expectations? And there's just nothing for most people. You're running a business, all right? These are little businesses. You've got money coming in, you've got money coming out, you've got to treat it like one. So you've really got to understand what is required to build a portfolio of properties, right? Because if you just want to go out there and buy one property is not going to achieve significant financial goals. You're better off having bought none, but it's not going to set you up financially, right? So the things that we need to consider is, number one, you've got to take into account your financial goals and your exit strategy. And we've got to be very serious about this. You've got to write it down and you've got to add timelines to it. Yeah. You've got to think about how you're going to turn that property strategy into achieving those outcomes. What is your exit strategy? In order to build the portfolio, you have to understand how finance works, right? Because finance is what you require to build the portfolio. You're not using your own money. You're not using cash. You're going to the bank. The bank lends you money in a certain fashion. They have policies there. You have to understand those policies to know how to navigate those to keep getting money. You're basically trying to put yourself in as much debt as possible, but it's good debt, guys. It's not bad debt. It's good debt. It's low interest rates. It's tax deductible, and you're using it to invest in assets that are appreciating in value, right? It's not bad debt, right? You know, it's not like credit card debt or anything like that. So you need to understand how to borrow. So we'll touch on that. You need to make sure that you're targeting locations and properties that meet the requirements of the finance strategy. So what do I mean by that? The properties that you buy also impact your ability to get finance. The bank isn't just looking at your personal circumstances. They're looking at the cash flows on the property, and they bring the two together, and that's how much they're going to lend you in the future. So you need to understand that dynamic. And then, of course, you apply your standard investment criteria. So standard investment criteria is obviously investing in right locations, looking at demand, looking at supply, looking at the cash flows on the property, all those things that typically relate to an investment property. However, if you focus on investment criteria first without focusing on the points above that, you're going to run into an issue, because you can have a whole range of properties that have good, strong investment criteria, but they're still not tailored to your personal circumstances, right? So I'll touch on that as well. So that's the portfolio grade strategy. How do we apply it? Well, the best way to do it is to first understand finance, okay? I'll touch on this. This is a calculator, all right? So this is how banks work out how to lend you money. You can go online, you can jump on these calculators. You'll notice in this calculator, they're looking at cash flows. Now, obviously, there's other things that they're looking at, but the main one is serviceability. How do you plan to service this debt, right? Well, in this instance, you're buying investment property. So I want to look at the income coming in and I'll look at the expenses. That's how they lend money. So when you put the property into those calculators and you think of the cash flows on property, there's mainly three types of properties that we talk about with regards to cash flow. There's negative, neutral, and cash flow positive. So negative is where you buy a property, you have a loan against it, but the rental income doesn't cover all the costs of owning that property and the tax deductions, etc. Neutrally geared is where you are getting enough rental income or tax credits to cover the costs, so the property pays for itself. You're not having to put your own money in. Cash flow positive is where that property has a high enough rental income and tax deductions that you're receiving cash flow positive income. Why is that important? Because those three types of property will have a significant impact on how much banks will also lend you when you go for that loan. So to give you an example of how this works, here's a table, and on the left-hand side, that shows you how much you can borrow. All right. In the middle, I've got a sweet spot there. That white line represents the benchmark in terms of what you don't want your borrowing capacity to drop below, and in that instance, 500 to 600. Why? Because once you start spending less than 500 or 600 on an investment property, it makes it very hard to get into good areas, good locations, good properties, etc. Obviously, due to affordability and what property costs these days. Yeah. So you want to make sure your BC stays above that. Now, unfortunately, a lot of investors will come to me and I'll say, Jace, look, we bought a few properties a few years ago, and the banks won't lend us any more money, because what they've done is they've gone, look, we need to invest. They've jumped on realestate.com, went to maybe a property in their local area. Most properties in our major capital cities are negatively geared, not as much at the moment because record interest rates are so low, but as a general rule, they're negative, because in a lot of our major capital cities, we've had good growth, but the rental yields don't grow at the same rate. So you get a situation where the income is not covering the cost of anything. Now, the client didn't care at the time because they could put a little bit of their own money in. And then a few years later, as you can see there, year two, they've decided to go buy another property. Now, what they haven't realised is that their borrowing capacity has dropped, all right, because the first property had negative cash flows. So if you buy a property with negative cash flows, you're taking on a liability. It's reducing your cash flows and therefore reducing your borrowing capacity in the eyes of the banks. Now, luckily for them, when they bought the second property, their borrowing capacity was still high enough just to sneak in that second, right? But they didn't know what their borrowing capacity was. They just put an application in and the bank said yes. Now, a few years later, they can see that the properties are growing in value and they think this is great. We've got to get more. Let's build this portfolio. This is how we're going to set ourselves up. They see the light at the end of the tunnel, but they go to the bank for the third one. The bank says no, and they can't understand why. The properties have gone up in value. Why aren't they lending any more money? Because banks don't lend you based on property values increasing. They lend you based on your cash flows. And because those two properties were both negatively geared, that client can no longer purchase any properties unless there's some sort of significant change in their personal lives, in that they're able to really substantially boost their income or pay down a significant amount of debt, but they're sort of stuck. So had they come to us, we would have explained that, look, you're in a good position and you can certainly buy a negatively geared property now, but we would suggest that that's going to bring your borrowing capacity too low. So the second one, you might want to consider a couple of properties that are cash flow positive. Then your BC will come back up again because that cash flow positive income will help with your borrowing capacity. Now you can go out and get another negative or a neutrally geared property. But my point being is that when you grow your portfolio, you can't make drastic changes to your personal income. Like you can't go into work tomorrow and say, look, I want to build an investment portfolio. Jay says I need to earn more. Can you give me a $50,000 raise? Right? It would be lovely, but it's just not going to happen. So you can't significantly change your personal financial position overnight, but you can do it based on the properties that you select. All right. So this is really important because if you don't get this right, you will hit a brick wall of finance, as most people do, and you'll get stuck. And in some instances, I had clients sell some of their heavily negative geared properties or heavily negative cash flow properties so that they could take a few steps back again and then restart building their portfolio with the correct selection of properties. So guys, finance is key, right? You can't build a portfolio if you can't get finance, right? You just can't. It doesn't matter how much research you think you've done on a particular location or how good you think an investment property is. If you haven't got a finance strategy, eventually it will come back and bite you. All right.
Jason,
yep.
A lot of questions, which is very timely now that you're moving into the questions, about the strategy session. So can I just remind everybody that if you would like to access the strategy session, it's on the right-hand side, and you just need to click on that and it will take you through to it.
Absolutely, guys. Look, as part of this process, we want to keep giving you as much value as possible. So any strategy sessions that you want with myself, Thomas, or the team, obviously these are complementary because of this webinar. You have the access, you have the opportunity to do that. We can do them face to face, we can do it over Zoom, etc. All right, so I've got another ebook here for you guys. This is Financing Principles. So this talks about what we just talked about then, but it also talks about structure, which I'm going to go into shortly. So be sure to click on that ebook there as well. Now, the best way to show you how a lot of this stuff works is to use a case study. In this particular instance, we're going to use one of our clients, Gary Young, who caught up with us just over 3 years ago. I love Gary's story because he came to us. He unfortunately gone through a divorce. He had some back issues, knee issues. He's walking down the docks, and they were talking about making a lot of the full-timers go to casual and part-time. He was worried about that. He's roughly 8 years out from retirement. He knew he needed to do something. He had some equity in his home. He jumped online, was looking at shares and got really confused. And even property, he was still confused about where to buy, what to buy. So he came in for these strategy sessions, and we sort of educated him on what to do. So the first thing we did is talk to him about, what were some of his goals. So he wanted to retire in 8 years. He wanted a passive income of around 70,000. He had equity in his home. He had money in super. He wanted a passive investment, and he wanted to retire in Thailand. Absolutely loved Thailand. Nicola, just on that poll, how many people did we have out there that had property?
Okay, so 26% of people did not have a property, 66% of people had 1 to 2, and only 6% of people had 6+ properties.
Okay, well, that's pretty consistent because usually 95% of investors out there only have 1 or 2 properties, all right, which is pretty consistent. The strategies that we're teaching you tonight get you beyond that, because on average you want to aim for about 5 to 6 properties, which is sort of a bit of an average in terms of building your portfolio. So let's have a look at how we can do that. So with Gary's strategy, what we had to do, we had to target neutral and cash flow positive. And the reason for that, it was only Gary, it was just his income. He wasn't on a bad income, but we had to protect his borrowing capacity. We also targeted low establishment cost strategies, so properties with small deposits, small stamp duties, etc. All right, because I wanted to leverage his equity as much as possible. So again, 60% of you have properties at the moment. You've got a home or investment properties. You don't want equity sitting in there that's not liquid. You want to release that equity as quickly as you can, and we can do that through a master facility, which I'll show you. And then we want to find a way to convert that portfolio to generating income for you at a later date. So with the high cost and low cost strategy, this is really important. I'll skim through this because I'm just conscious of the time, but a lot of clients come to us and they go, well, Jace, how much should I spend on investment properties? Should I buy established? Should I buy new? What should I do? Well, in my business, when I started 12 years ago, I was a bit of a snob, right? I wouldn't buy new or off the plan properties. I'd only buy established properties within 10 kilometres of Melbourne. And it wasn't all over Melbourne. It was literally just in the east or the southeast suburbs, yeah? But over time, those properties increased in value. It was just impossible to continue to buy in there for the clients. So obviously, as a business now, we look everywhere. But if you are buying established property, we tend to refer to it as a high-cost strategy, because when you buy it, once you put your deposit in, or to get something decent that's established in a, a sort of, an infill sort of location in one of the major capital cities, they're bloody expensive. Even on $800,000, you've got to put in an $80,000 deposit if you do a 90% lend. Then you've got your stamp duties, your lender's mortgage insurance, all the rest of it. If it's an older property, you might have to add some value to it, update kitchens, bathrooms, painting, fittings, fixtures. You might end up at the end of the day putting about $170,000 or even $200,000 in that property. It's a lot of cash or a lot of equity to put in that property. You're not really leveraging your position as best you could. And then on top of that, because it is an older property, your rental yields tend to be lower because obviously people aren't paying a premium because it's not new. And that might be negatively geared, maybe $150 a week. So you're also putting in $150 a week to hold on to that property. Now, a lot of people do it because these properties can deliver some good capital growth, but it is what we call a high-cost strategy. A low-cost strategy has become a lot more popular over the last 10 years, and that's for people that are looking at, either house and land packages, new townhouses, also apartments. Now, we're not a big fan of apartments. We don't like apartments. We don't like apartments in high-rise and stuff. Just because of supply issues, but certainly something boutique in the right location we would have a look at. But for the most part, a lot of people want a bit of land content there in their properties. And with something like that, you can also get something that's more affordable. You can put a 10% deposit down. You can get stamp duty discounts as well, because like, for example, if you buy a plot of land and put a house on it, you'll only pay stamp duty on the land component. So again, in that instance, you could purchase something like that and only put $65,000 in. So for a lot of you that only have a little bit of cash or a little bit of equity, something like that would work a lot better for you. But more importantly, if you don't have a really high borrowing capacity, that's also going to help you because the property is brand new and you've got strong rental yields. The property will pay for itself or it's cash flow positive, which in the eyes of the bank makes them very happy in terms of lending you more money in the future. So some things to consider. Now, in terms of Gary's situation, we couldn't do the high cost strategy because we only had 8 years to work with, and I had to try to get as many properties in there as I could. And certainly his income wasn't high enough to sustain a number of those high cost strategies. So we focused more on the low cost strategy for him. So in this strategy, we also looked at something that he didn't have to invest too much time in. It was more passive investing, so buy and hold strategy. And buy and hold strategies typically only work when you've got a portfolio of properties. It's very hard to make them work because you've got to give them time if you've only got one property. So always when we're working with the clients, we're always working on strategies to help you grow a portfolio rather than just have one sitting in there. Look, the advantages are you can grow big portfolios, you can build wealth while you sleep, they're less risky, you've got strong returns over time, and they don't require a strong financial position, because you don't need a lot of money to put into them. And also, too, the rental yields are quite high on those properties. So if you want to understand a little bit more about different property types, investing in, houses, townhouses, established properties, apartments, dual income, all that sort of stuff, download that ebook for you. We've got an ebook there for you on the side as well.
Before I make that live, we actually had another poll that I ran because I was interested to know what everybody's most important financial goal was. That was around the time we were talking about Gary. So can I reveal the results of that poll?
Yep.
So 19% of, actually it's changing. People are still, there we go. Sorry, let me just end the poll so that we can there we go. Okay, so 19% of people said a comfortable retirement. 3% of people said pay off the mortgage, 3% of people said pay less tax, 3% of people said help the kids, and 69% said become financially independent.
Yeah, absolutely. So look, we all want the same things, guys. So people come into the office and I go, tell me about your financial goals, and I'm already writing them down for you. But at the end of the day, it's all about just having more options in life. All right, that's what we want. We just want more options in life and to be financially independent. Another thing to be really, it's really important, and as we educated Gary on this, is that if you're going to invest in a market to generate a certain return over time, wouldn't it make sense to always try to invest in a rising market? Now, again, we don't have a crystal ball, but we do have some strong indicators there in terms of what the markets are doing nationally. And what you must understand is our markets don't operate all the same. So you can have a situation where Melbourne's flat. You can have a situation where Sydney's actually in a correction, but then you can have a situation where another state somewhere, be it Brisbane, is actually going up in value. So our states operate on different markets. We go through a boom period, then we're in a declining market where the markets might correct a little bit, sit flat for a while, and then they take off again. So the point is you've got to get comfortable with investing in other states. Now, sometimes it's hard to do it on your own. Obviously, as a group, we do it all the time because we've got people on the ground in every state. But you really want to make sure you're diversifying your portfolio. Don't buy all your properties in the one location because there will be a period where that market sits flat. And if it's flat, we can't generate wealth. We can't pull equity out of those properties. We always want to make sure that we've got them in different locations.
Jason, before we move on, can we run that poll just from the previous slide?
Sure.
So the question is, would you buy property in another state?
Cool. All right, so let's have a look at that answer too. Now, let's have a little bit more of a chat about infill versus greenfield. So what is infill versus greenfield? All right, here on my screen, I've got a map of Melbourne, okay? So as I said before, 12 years ago now, I can't believe it's 12 years ago, I used to just buy in here. I was a bit of a snob, right? I'd only go within these areas. I was buying, you know, flats and townhouses and things like that for my clients. You know, some houses too, but it just got so expensive, right? And then we had to push further and further out, and then we started going into these growth corridors. So with the infill locations, it's very expensive. It's very hard to buy in those areas. The rental yields are a lot lower. You need big budgets. You know, you're needing $1 million now to buy in some of these locations, and certainly if you're in Sydney, you know, more than that. So what's happened is as prices have increased, the rental yields haven't increased at the same rate. You know, in some of these locations, your rental yield might be as little as 2.5% on a house. You know, it's just, it puts you in a very vulnerable position in terms of your cash flows, but also stuffs you up in terms of the finance. So what a lot of clients, investors are doing now is purchasing in a lot of the growth corridors. So for example, to give you an example, we've got a suburb over here called Berwick. So how does that work? Well, Berwick many years ago had a lot of available land, and the developers would move in and build housing estates. And so within those markets, you've got two markets. You've got what we call your macro and your micro. Your micro market is within an estate. So for some people who've got a lower budget, they can only spend maybe $500,000 or $600,000, but they want something that's new. They don't want to have to worry about maintenance and things like that for a little while, but they also need a high rental income to satisfy the banks. But they want to stick to a metro location. They might go into a growth corridor like that. Now, by going into that estate, over time, the estate releases stages. And when they release those stages, the land prices go up. Now, why do they go up? Because the homes are going in, the schools are going in, the parks, the shops, the infrastructure is going in. So it's becoming more desirable. People are prepared to pay more. That's how the developer makes his money on the land. But you as an investor equally make money. So you may have bought your piece of land for $150,000 or $200,000, and then maybe it's jumped up, you know, 20, 30, 40, 50,000. Recently, a couple of years ago, 2017, 2018, some clients had bought a parcel of land, settled on it a year later, and it was worth as much as $80,000 more, and they hadn't even settled on it yet. So that sort of is what happens within the estates. Now, over time, just like Berwick, the other estates come into play, and then all of a sudden, you don't have any available land left in that area. So it becomes an infill location, and as population increases within those areas, obviously everyone's fighting for the existing properties. They can't add any more dwellings, and then obviously that pushes up prices in terms of your long-term strategy. In Melbourne, it's a little bit different, as with most major capital cities, because we still have to deal with an increasing population. I think they're expecting around 8 million people by 2050, I think it is. So where do we put them all? Well, this is where on all the major roads and intersections, you see all the high rises going up, or the medium density going up. Yeah. So even though our population is increasing, they're still going to continue to add dwellings along all those major arterials. So the long and the short of it is, if you don't have the budget and you can't purchase within those infill locations, or your borrowing capacity won't allow it, then you might want to consider some of these growth corridors, but then also too, some of the regional areas. So a lot of the regional areas are doing quite well. They're forecast to do quite well, particularly as a result of COVID, because a lot of people now can work remotely and they don't want to move away from the big city. So a lot of the regional centres have done incredibly well. Ballarat isn't there on the map, but certainly Ballarat were buying new homes in there not too long ago for as little as, you know, 350,000, and now they're all sort of pushing 450 plus. So, you know, some good opportunities out there as well in terms of price points, etc. So then what we had to look at is, now that Gary understood a little bit about how to build a portfolio, now we've got to look at how to set up the finance. So the first thing we did is, Gary had a home, and he had a very small mortgage on that home. So we took some equity out. We created what we call a master facility. So for those of you who have equity, you need to get your equity out, create these master facilities. For those of you who've got cash, think of your master facility as simply an account or an offset account. It's got some cash in it. So what we did is we pulled out $300,000 and put that into a separate account. Now, Gary's mortgage didn't go up. He had a separate account for his mortgage. This is a separate account for investment purposes. So then what we did is we got started with his portfolio, and we bought 2 properties right off the bat. So if you make the decision to invest, we'll invest. What is the point? Gary's got 8 years. There's no point buying one property today, waiting a few years and getting another one. He's going to run out of time. So we implemented the multi-purchase strategy. We got one in Geelong, one of our fastest growing regional areas. A quarter of a million people out there, expecting 400,000 people by 2030. So it's just going gangbusters out there. Bought him a brand new house and land package, very low vacancy rates, simple, it's really easy to rent. But look here, very small deposits, very small costs. He also got stamp duty savings because he paid stamp duty on the land. Then, of course, we went to Cranbourne on the other side. Again, that was one of the fastest growing municipalities. A lot of homes being built, but equally a lot of families. There was like 200 families moving into that location every week. And as you can see there, you've got deposits, very small deposits, very small stamp duties. These properties were neutrally geared, and one of them was cash flow positive. I can't remember which one. But my point being, he was able to buy 2 properties, small deposits, small cash flows. It come from his master facility. So he's not putting in his own money into this. He's just using his equity, and the tenants and the tax deductions are covering all the costs, right? So what does Gary do next? Because we've only got 8 years. Well, you guessed it, we went out and bought more properties, but this time we diversified. So we looked at Brisbane, all right, because Brisbane was doing well. We looked at a townhouse. So again, we had to look at properties that were affordable within his budget, but also helped him with his borrowing capacity. Now, mind you, this was late 2015 when we started doing this. Lending back then wasn't as tight as it is now, so it was easier to lend back then. But either way, we were able to buy 2 properties, and one being a townhouse and one being a brand new home. So now he's got 4 properties in that portfolio. So what do we do next? All right, so roughly 9 months later again, so we did this in the space of I think it was about 2.5 years we did this. We went out and got another couple of properties. So now he's got one in Augusta, and now he's got one in Rockbank. But we had a bit of a problem with these 2 in terms of funding these, because if you have a close look at his master facility, he doesn't actually have enough funds. So we had $300,000 in total, but to get property 5 and 6, we wouldn't have had enough funds. So, all right, so what did we do? Well, then that's where we made the decision to purchase through a self-managed super fund. And in doing so, because Gary had a bit of super, we were able to purchase another property. So now he's got 2 properties in super and he's got 5 in his personal name. To make the 5 work in his personal name, we had to top up his master facility. So we simply went back to the home. The home had increased in value. When you release equity, you can go right up to 90% in some instances. In this instance, we had a loan of $380 against his home of $480. He had a very small mortgage, something like $20,000 or something on his mortgage that he was paying off separately. So now he's got enough money in his master facility to buy 5 properties in his personal name. He's got money left over in the master facility, which we call a buffer. So you always want to make sure you've got a buffer, covers you for incidental costs, or if you don't have a tenant in your property. The whole purpose of this portfolio is independent of Gary, right? So you got to remember, Gary's still working at the docks. He's still working full time. They didn't make him part time, which he was worried about. He's still got a good income coming in, and he's using that just to pay down the last of his mortgage. Now, and he's got 2 properties. So in his super fund, he did a 70% lend. So he didn't need to use much, roughly around that $140,000 to purchase one of those properties at that price point of in around $400. Those properties, again, are in his super fund, and they're independent of his personal property portfolio. But as you can see there, very quickly, Gary went from 0 to hero overnight in order to be in a position to set himself up for retirement, because we only had 8 years. So, as I said before, to organise all these structures, you need someone that really understands finance. If you walk into a bank, they're not going to teach any of this. They're just going to put an application in front of you. Brokers are fantastic, but also a lot of brokers tend to deal with a lot of home buyers. Really, what I asked you to do is speak to a broker that specialises in working with investors, because a broker who works, a specialist who works with investors, is not looking at your loan application today. They're looking at how your purchase is going to impact your ability to get the next one and the next one, and how they place the deals and with which banks, because you can't put them all with one bank and all this sort of stuff, right? You've also got to make sure all these loans are independent, right? They're not all cross-collateralized, they're not all linked to your home and all this sort of stuff as well. So there's all these things that you need to do. So to learn about the finance, download this ebook on the right-hand side, and it's going to talk to you about, getting specialist advice. You should always get specialist advice. So then if we have a look at some of Gary's properties, you can see there, that's Charlemont. Hang on a minute. Let me just, it looks like I'm covering the actual, oh no, I can't see it for some reason. That's Charlemont. That's had about 27% growth. Oh, there it is there. Yeah, 27%. That's Cranbourne, capital growth, 30%. 8% there. Some of these other ones had a little bit less growth just because he bought them more recently. That was Rockbank. That was interesting. Rockbank was a new suburb. Clients would go out there and go, Jace, it's just cow paddocks. It's just cow shit everywhere. Why would I invest out here? There's new suburbs going in there. And I get there's land everywhere, but you can't just go out there and put houses anywhere. They've got to open up the land. They couldn't open up quick enough. The demand was there. You got new suburbs going in, train stations, shopping centres. Everyone piled in there. And the prices just went through the roof. So that was actually one of his best performers over a very short period. So if we have a look at, come back to his portfolio. So over that period, he's generated close to $500,000 in equity. You can see there with the equity in the top. So, you know, now he's a very different guy. You know, now you can see that he's really in a position to set himself up. He's also experienced lower interest rates at the moment. So a lot of those properties are cash flow positive. So he's building equity, he's generating income, he's got properties in his super that are leveraged as well. So it's really happy days for Gary. So let's run some questions, guys. Let's ask me some questions because a lot of people are looking at this and going, well, how the hell does Gary do this? Surely that's not possible. Well, it is under the right circumstances. As I said before, when we started, it was a little bit different. That was before the banks really tightened up. But the methodologies don't change in terms of understanding how to tailor a property wealth plan to your circumstances, your timelines, your goals, your lending position, etc., and how to manage the cash flows. But let's run through a few quick questions. Let's talk to me about what can go wrong here, right? Because he's bought a lot of properties very quickly. So let's have a chat about that. What do we got? Got some questions coming through. Sorry?
I'm just putting the questions there so you can see them. Has that first one?
Yeah, I've got some here. So Rob's asking, what if Gary's properties are vacant? You know, what happens then? Okay, so with Gary's portfolio, because he's got a master facility there, all the income feeds into this and all the costs come out. These properties are all neutrally geared or cash flow positive. So even if he has a property or two or even three that aren't rented, it's not as if they're not going to be rented for a long time. We target areas with very low vacancy rates, right? So you might have someone back in there within a few weeks or worst case scenario, a couple of months, but the mortgage repayment comes from the master facility. It doesn't come from Gary's pocket, yeah? And because he's got a buffer there, that's how he would cover that. So that's the whole purpose of having these master facilities. And for those of you who have cash, your master facility would be the offset facility. What else can go wrong? What if Gary loses his job? Great question, Rebecca. So if Gary loses his job, as I said before, the portfolio is independent. Nothing changes. All right. These properties don't rely on Gary working. They rely on Gary working if he wants to borrow money. But Gary's done now. He's not buying any more properties, right? He set himself up. He's just got to wait now through to retirement. All it means is that, you know, like he'll just go get another job. If he plans to retire earlier, it would affect some of the cash flows on these properties because of the tax deductions and things like that. But he's not having to put any of his current income into this portfolio. If he's got spare cash, I tell him to pay off. You've got to pay off your personal debts first, so your mortgages and stuff. And then if you've got no personal debt, well, yes, you can put some savings into your master facility to top up that account, or you just release the equity. So you can see here the black stuff here, that's his equity. We can go back and release that and top up the master facility as an option as well. And he's already done that with regards to some other programs that I'll touch on. Interest rates, Kieran's asked, what if interest rates go up? Yes, they're at record lows. So interest rates will fluctuate up and down over time. But again, that's why you've got the buffer there. So if you do have some properties that go from being neutrally geared to a little bit negatively geared, well, the buffer can absorb that until such time that your property increases in value, you pull out the equity and top it up. But also you adjust your strategy. So if interest rates are quite high, you target properties that have very high yields that can offset some of those high interest rates. So you just adjust your strategy over time. So as I said before, guys, it's absolutely critical that you understand how the finance works and you understand that portfolio grade strategy, so you can also, over time, generate results similar to this. All right, so this is where he's at now. This is called our Alliance Corp Property Wealth Accelerator program. It first starts by accumulating property to get the property up and going. This is where we build your foundations. We look at other options to leverage, be it through your self-managed super funds, etc. You can see here Gary has gone off. He's jumped the gun. He's gone and bought a house in Thailand. We don't actually know what it looks like. I've told him to bring me a photo, so we just pulled that off the internet. It sort of looked like a Thai house. The marketing girls did that, but he wasn't supposed to do that, but he's already jumped the gun, and he's already talking to me about moving to Thailand sooner and retiring sooner. Again, I'm trying to talk him out of it because it wasn't part of the strategy. I want to give the portfolio a bit more time, but you can see that it has had a significant impact on him. Also part of the strategy, his exit strategy, is that in the business we also do syndicates, we do developments, and the purpose behind that is so that Gary can use some of that equity and generate some cash flows for himself to start replacing his income, because we've got to generate that $70,000 in income, but also too, when we get to retirement, we'll start to sell off some of those properties, and we can use those capital gains to also feed into some of the development strategies. So he'll sit in Thailand. He'll still own a few properties, but they'll be paid out because he would have used the capital gains from the others to pay him out. And he'll have some in his super, and then he'll also have some money sitting in the syndicates that keeps turning over to generate his income. All right, so as you can see there, he's really heading in the right direction. In terms of what some of his properties, the cash flows, I just wanted to quickly point this out. This is one of his properties here. At the time that we bought it, it was neutrally geared. So that's the figure there, it's $7. It was making him $7 a week. So you got to ask, well, why would you do that? Well, he's not doing it for the $7. He's making sure the property doesn't have negative cash flow so he can get finance. He's doing it because obviously the property is increasing value over time. All right, so that's why he's doing it. Now this report here is the same property, except that now I've put in today's interest rates. And as you can see now, this same property is generating close to $6,000 a year. Now that's just one property. All right, now he's got a whole portfolio of them. So now those lower interest rates have made a significant impact to the cash flow positive income that he's now generating, along with the capital growth that he'll be receiving in the future. So guys, that's the portfolio grade strategy. Focus on your goals, your exit strategies first, then focus on a finance strategy. Then make sure you're targeting properties and locations that meet the requirements of the finance strategy so that you can continue to borrow money in the future. And then make sure that those properties and those locations meet strict investment criteria. So what I wanted to talk about now, Nicola, is we'll probably jump into the offer just because I'm conscious of time.
Could we do the poll results just before we do that?
Yeah, absolutely. Let's have a look.
All right. So would you buy property in another state? We had 86% of people say yes, they would. And then 13% of people said no.
Okay, cool. All right, so there's most people are pretty comfortable with that, so that's great. All right, so guys, I hope you've learnt a lot tonight. I'm sorry for some of you started at the beginning and the screen went blank. I had no idea what was going on there, but that's the joys of running live webinars. But let's see what we can do in terms of giving you more value. So I'm just trying to give you as much value as we can. The best way to do it is to get independent advice on how this works. So we've got this special offer for you. So what we've organised for you is these complimentary strategy sessions, normally valued at $500. What this is the opportunity to speak with a senior property coach. Okay, so if you're in another state where you're not in lockdown, you can meet them in person, or we can do it over Zoom if you're in Melbourne. It's roughly 90 minutes where what we do is we first of all assess your current financial position, so what you look like in the eyes of the banks. We have a talk to you about your financial goals and things like that. You can also talk to Thomas as part of the strategy to talk about your super or setting up a self-managed super fund. And then we put together what's called a property wealth plan. And that's all about putting that strategy together that I showed you for Gary. So we showed that strategy to Gary when we first met him, right? We planned it at the start. It wasn't like, oh, Gary, let's go buy a property or two and see what happens. We're able to forward plan based on your current financial position, certain types of properties, making certain assumptions on what you can do over the next 5 years, 10 years, 15 years, or into retirement. So that's effectively what we're trying to do, put together a property wealth strategy for you. So we document.
Oh, can I just mention with that strategy session there, I heard that you might even attend the 3 first people to request the strategy session.
Yeah, absolutely. So I always plan to pop my head in where I can, but for those of you who register, certainly I can do that as well. Look, if I could run all these sessions with my clients, that's what I love to do. I love to be at the whiteboard teaching you guys how to do this, but we've got a team, we've got nearly 30 staff that run around and can help you also. So that property wealth plan will then talk about, a strategy that involves, buying all different types of properties. It could be buying new, established properties. It could be buying properties in our metro locations. It could be in regional areas. Yeah. Now, the strategy itself also focuses on the service that we deliver, the outcomes. You can jump online and have a look at all of our 5-star reviews. But also at the end of the strategy session, you will have a blueprint there. You'll be a lot clearer in terms of what you can do based on your current financial position. You'll be clearer on what sort of strategies, what are the best locations. You'll have all that information. But what might be missing for you is, how do I actually implement this, Jason? I'm so busy. I'm very busy with work. I've got a family, whatever. I don't have the time to do this. Or I'm not confident yet to do this. Is there a way in which I can fast track my results like Gary? Well, absolutely. At the end of the session, if you like what you hear, what we can also offer you is the opportunity to also experience what we call our property wealth program. So our property wealth program is where you continue to come back for future sessions, where we continue to mentor, educate you, teach you, help you put the finance together, help you find the properties, do all the research, due diligence, do all the negotiations. And at the end of the service, if you love what you see, well, then you can become a member. Our membership program is a lifetime membership like Gary has, and you keep coming back into the office in the future, where the team can help you and continue to help you build and grow that portfolio. So certainly have a chat to the guys about that. So guys, thank you so much for tonight. Look, I really feel for a lot of you who are in Melbourne, who are in lockdown. It's a bit painful. Hopefully it won't be too much longer. For those of you who are in other states, and enjoy your freedom. I know that there's still some restrictions, but certainly not like what we're dealing with. But my point is, guys, the market is doing exactly what I thought it would when I came to you, back in March and ran these webinars to say, hey guys, the sky's not falling in. Property's very resilient. We all need to live somewhere. Don't listen to the papers. And of course, what are the papers saying now? Property's going to take off again, right? And you don't want to miss out on that. And certainly for those of you who've got a lot of equity or you've got super there, talk to Thomas as part of these strategy sessions. They're complimentary. You've got nothing to lose, but everything to gain. So make sure you register for those and just keep an eye out for any other webinars we have or any videos or ebooks or things like that. So again, thank you guys tonight. I wish you all the best. You stay safe. And we look forward to running one of these strategy sessions for you. Thank you.